Yeah. So for our financial statements is basically accounts for the end of the year. That means at the end of this year, we want to know what our profit is. We want to know if we've made loss. We want to know the value of our assets. We want to know the value of our liabilities. We want to know the capital invested so that we can take decisions for the next financial year. That is what we need financial statement for. So to prepare your financial statements, you need a trial balance. Are you with me? So in the trial balance consists of the combinations of all what we've prepared in our ledger, in our books of prime entry, or books of original entry. I think you remember that, right? Yes. Good. So for the financial statements, we have two sides. We have the income side, an income statement which comprises the trading and profit loss accounts, and we have the statement of financial position, which talks about the assets and liabilities. That is clear. Now, to prepare a financial statement, first we need a trial balance. In this trial balance, we're going to have all the values of all our transactions put together. So for us to put them together, we have to create the side of the trade, sides of the profit and loss, and the sides for assets and liabilities. So here they said the following trial balance was extracted from the book of Samuel at 31 May 28. This trial balance will be used in walkthrough. Okay, now we have this. So what I'm going to do with this is this. Based on the trial balance we have, I'm going to explain these are items in the trial balance. So I'm going to explain where each item has to be posted and what for. Are you with me? Yes. So we start with revenue. Revenue is the same as sales. Okay? So when you use a T account, to prepare your fund, here we're going to prepare our trading profit or loss account, income statement. So we call it statement of profit or loss using this income statement. So when you have to prepare the trading side, the first thing is your sales. Your sales will be on the debit side of your account. We have the debit side and the credit side. Your sales goes to the credit side. Sorry. So on the credit side, you have your sales. You have sales returns. You less sales returns from your sales. Because sales is what you have sold, yes or no? Yes. Then there's returns. Return inward. So sales returns is the same as what? Return inward. So you less return inward from your sales on the credit side. So on your debit side, you have purchases. As long as you have your purchases, is there, you less purchases returns because you return those goods to your suppliers, yes or no? So that is return outward. You less return outward. Is it clear? Yes. Carriage inward. What is carriage? Remember we said carriage is what? The payment on goods that has been, that comes to the premises of the business. That is carriage inward. Payment on goods that has to be delivered to you is carriage inward. It's part of your trading account. The carriage outward are the amount you pay on goods that are going out to customers. That is an expenses. So it goes to your profit or loss account. But we are still talking about the trading account. So for the trading account, the items you're going to have are your revenue, which is the same as sales, your less sales returns, which is the same as return inward, then your purchases on the debit side, your less purchases returns, which is the same as return outward on the debit side, you less it. Carriage inward, you add carriage inward because it's an expenditure for trade. So you add it to your purchases. Is it clear? Yes. Inventory, which is stock, you add it on the debit side. It's part of your trading, isn't it? Yes. Those are what you are selling as a business. So stock is what you are selling. Discount received. Discount received, discount allowed are part of your profit or loss, not part of your trading account. Are you with me? Discount received. You have discount received, you have discount allowed. Discount received is when you buy goods and you are given a certain discount. You add it to your trading account. Discount allowed goes to your credit side because you are paying, you are giving customers that. Do you get what I'm saying here? All right. Then we have wages. Wages goes to your profit or loss account because it's an expenses, isn't it? Yes. General expenses, things. General expenses goes to your profit or loss account because it's an expenses. Property tax is tax. It's an expenses. It stays in your profit or loss. Premises, loan interest, not loan, loan interest. Loan interest is an expenses. That means you are paying interest on loan. It's part of your expenses. Premises, It is not part of your trading and profit loss account. It's part of your statement of financial position. So it goes to your statement of financial position or balance sheet. Fixtures and equipment is an asset. Premises is an asset, it goes to your statement of financial position. Fixtures and equipment is an asset, it goes to your statement of financial position. Trade receivables, these are your credit customers. It's part of your assets. Are you with me? Yes. First, note that we have two types of assets. We have current assets and non-current assets. Non-current assets are those assets that stays with the business for more than a year. Current assets are those assets that cannot last than a year. So example of current assets are trade receivable. Example of non-current assets are premises, fixtures, and equipment. Are you with me?
Yes.
Trade receivable is your credit customer. They have to pay before the year ends, yes or no?
Yes.
So it is a current asset. Trade payables, it's a current liability. These are liabilities, these are debts of the business that cannot last more than a year. You understand? So you are owing your credit, you are owing your suppliers. You have to pay your supplier before the year ends, isn't it?
Yes.
Good. So trade payables are your creditors. Trade receivables are your debtors. Clear? Debtors are part of your asset, which is current assets. Trade payables, which is the same as creditors, are your liabilities, which is part of your current liabilities. Bank is an asset because this is the money you have in the bank. Cash at hand is the money you have in the box, in the safe of your office, of your business. Long-term loan is a non-current liability. It means these are loans that will stay more than a year in your business, yes or no?
Yes.
Capital goes to part of your liability. So capital and liabilities are together. Then drawings is part of it. So you less drawings from the total of your capital. You know, at the end of the year, you'd have made profit. So when you make profits, listen, when you make profits, in your statement of financial position, you have on the credit side, you have the trade payables, you had them with your long-term liabilities, you had capital, you had profits, and you less drawings. Do you get what I'm saying here? Do you get it or not? In your liabilities and capital and liability, you have your profits. First, you have your capital. You have your capital.
Yes.
As soon as you have your capital, you add the loans you take. You had the loans. You had your trade payables. All of them to be added. You had your profits. And you less your drawings. Because drawings is the money of the owner of the business. The money the owner of the business withdrew from the business. Yes or no? So yes. At the end of the year that you are preparing your account, you have to take away that drawings from it. As you are adding capital, you less drawings. And that is how you prepare your statement of financial position. So let's look at the analysis here. It has been prepared. So here we start. The trading section of our trial balance. So for the trading section, we said the trading section is concerned with buying and selling, and its purpose is to calculate the profit earned on the goods sold. This is called the gross profit. So at the end of the day, when we are done with preparing our trading account or the trading section, we call it trading account, we need to get the gross profit. And how do we get the gross profit? Gross profit is selling price minus cost of goods sold. Sales minus cost of sales. Your sales is your sales minus less returns. Whatever you get, you take it away from your purchases, your carriage, and the rest. Do you get what I'm saying here?
Cost of sales.
Sales minus cost of sales is your gross profit. So what are the items that makes up the gross profit? The items that makes up the gross profits are your sales items, your sales returns items, your purchases items, your purchases returns items, your carriage inward. Is it clear? Is it clear, please? No. We have cost of sales. How do we get cost of sales? Cost of sales is opening inventory plus purchases less closing inventory. The opening inventory are those stocks that we have in our business right now.
Yes.
As soon as we need to sell them, yes or no?
Yes.
Then because the stocks, we are running out of stocks, what do? We purchase more, yes or no? we had purchases to our stocks.
Yes.
At the end of the year, we have some stocks left. Yes or no? We need to know the value of the stocks left. You less it from what you have. That gives us our cost of sales. So opening inventory plus purchases minus closing inventory is our cost of sales. So cost of sales minus sales gives us our gross profit. So how do we get our sales? Our sales is sales minus minus sales returns, if there's any. If none, we just take our sales from cost of sales.
Yes.
Is it clear?
Yes.
So you have a question. Okay. So you have to put in mind that sometimes our trading account might have more than 3 items, not just opening inventory, closing inventory, and purchases. It might have more than that. Some of the items that can be included in our trading account is the carriage inward. So when you have carriage inward, you add it so it's going to be purchases, add carriage, less returns. Sometimes as the owner of the business, you might take some goods from the business, you less it, less drawings, goods for owner use, you less it. Is it clear?
Yes.
So the calculation of gross profit is shown in the trading section of the income statement. So we'll go down. Let's just go down. Now, they prepare the income statement, the trading section. So look at the trading section here. Are you there? Scroll down. Scroll down. Are you? Yes, yeah. Yeah. So look at it. We have the opening inventory on the debit side, then the closing the revenue on the credit side, right?
Yes.
You had purchases, you less purchases returns, less goods for own use. Note, please. As soon as you're preparing your statement of financial position, you know there's drawings.
Yes.
And goods for own use. Drawings is different. That's the money you took from the business. That is drawings. But goods that you took for own use is part of drawings. So you have to add both of them together under drawings. The value of the goods for own use and the value of the money you took as the owner of the business, you add them together, you less it in your statement of financial position. Is it clear?
No, that's all.
You don't get it?
Yes. You mean that
to prepare income statements, the trading section. Trade means that you are buying and selling. Yes or no?
Yes.
That's trade. So what comprises or what comes together? What do we have to put together for trading? Our stocks, what we are buying, purchases, what we are selling, sales, what we bought that we are returning, purchases, returns, what we sold that they are returning, sales, returns, the amount we spend to bring these products into our premises, carriage, the value of the goods that are left for the year, closing inventory. If the owner of the business has taken certain goods for personal use, it's part of our trading because it is goods. Where do we put goods? Trading. Do you get it?
yes.
Now, so how do we go about it? The opening inventory, which is 7,100. You had your purchases. What is purchases? The value of what we bought. Yes or no?
Yes.
The purchases returns, you less it. That's the value of what we return, the return outward to our suppliers. Less goods for own use. We deduct the value of the goods that the owner of the business, Samuel, has bought, took from the business for personal use. Then the carriage inward, you had it because it's part of our trading account. Then on the other side, you have revenue, which is sales, the value of the sales. Sales returns, the value of our return inward. The total, you put it there. Then we have our cost of sales. How do we get our cost of sales? The value of all what we've done minus our closing inventory. What is closing inventory? The value of the stocks that we are ending the year with. Do you get closing inventory? The value of the stocks we are ending the year with. You less them. So as soon as you less them, that's our cost of sales. From your sales, it gives you your gross profit. That's the value of our gross profit. So the value of our gross profit, we take it into the profit and loss account or the profit and loss section. We can't get our profit with this. We need to know this is gross profit. Profit before interest, before taxes. Do you understand?
Yes.
Before any expenditures, this is what gross profit is. Now, our gross profit minus all our expenses, all our overheads would give us our net profit. Do you get how we find our net profit? This is gross profit. It ends here. Our trading account, yeah, 29,500.
That's the gross profit.
That's the gross profit.
And where is the 94,000?
The total. That's the total of your sales on the both sides. Your gross profit is 29,500. You know why it's like this? Just hold on, please. Let me pull it out for you. So for the income statement, like I told you earlier, so we have our revenue. We have our revenue. You less revenue returns. Your purchases, you less purchases returns. You add carriage, you add opening inventory. You less goods for own use. You less closing inventory. The total of this will give you your cost of goods sale, because cost of sales or cost of goods sold. Then your value of sales is 94,700 minus the value of your cost of sales, which is 65,200. The difference between them gives you your gross profit. So your gross profit goes to the credit side of your profit or loss account. So in the profit and loss account, you have to prepare. As soon as you're preparing it, you start with the discount. So we have discount. Yes or no?
Yes.
Okay. So for the discount, we have discount received on this side. It's part of our income. Income on this side, expenses on the other side. Do you get my point here? As soon as you're preparing your profit and loss section, you have income on the credit side, expenses on the debit side. So income, part of income is your discount received. You receive discount, which means it's just like you are receiving money, because instead of you to pay 5,000, you are paying 4,800 because of discount. So you have 200 with you. So gross profit carried down. Now it will be brought down here.
Yes.
So you had discount
Received.
Discount received.
You should read everything.
Credit. Discount received. Income, it's income. Forget about ledger now. Forget about ledger. We're talking about income and expenditure.
Mm-hmm.
Because the difference between your expenditure and your income gives you your profit.
So received is a number.
So profit is total revenue minus total cost. So income minus expenditure gives you a profit. Did you get it?
Yes, yes.
So discount received is an income. Discount allowed is an expenses for you, because you gave, instead of your customers to pay you 5,000, they are paying you 4,800. So 200 is your own expense. Clear?
Yes, yes, yes.
So you had discount received, which is 400. It gives you 0,099, 29,900. Now, less overheads, which are the expenses.
And what?
Overheads, these are expenses of the business, which are, if there's carriage outward, you had it. You had discount allowed, wages, general expenses, tax, loan on interest. All these are expenses. Tax is an expenses, isn't it? Interest on loan is an expenses, isn't it?
Yes.
Carriage outward, the amount you pay to give your customers goods, is it not expenses? You had it. Do you get it?
Yes.
Then what do we have next? Loan. So the expenses are, we have discount allowed on this side now, which is 900. Yes or no?
Yes.
Wages, how much?
Wages.
11,200. General expenses?
2,800.
General expenses?
2,800.
2,800. Then what do we have?
Tax.
Property tax. Property tax. 600. So we add them together. That's all we have for expenses. No, asset. It goes to your statement of financial position. So these are all expenses. So you add the total together. It gives you 0,0, 0,0, This is 9 plus 8,
It says 17.
17, right?
17 plus 6.
17 plus 6 are 23. Are we sure about these values? We have, what about our loan on interest? You didn't put it. Interest on loan.
Interest in loan.
Yeah,
Oh,
loan on interest. Loan interest,
oh yeah. We didn't put
500, right? Yeah, we can just put it here.
Okay.
So we have,
Right, right for interest.
I wrote it already, loan interest. I wrote it, loan interest. Yeah, I wrote it. So you have 500, 900.
Right,
500, 900, that's 1,400.
plus 900. Okay, 1,400.
1,400 plus 200, that's 1,600. 1,600 plus 600, just calculate it for me. We have
How much is it?
500, 900, 11,200, 2,800, 600,
900. Up to 900. Isn't it? 11.
1,200,
11. Then 2,800.
2,800, yes,
And then
600,
16,000.
16.
Yes.
What about discount allowed? Okay, we did discount. 900, discount allowed. We did it, right?
Yes.
Discount allowed.
The wages, the general expenses, property tax, and loan interest. We did it all.
Okay, let's see. 1, 2, 3, 4, 5. 1, 2, 3,
Discount
4, 5.
received that
Yeah, we did discount received 400, yes. Okay, so what's the total here?
16,000
16,000. So 16,000 minus 29,900.
minus
16,000 minus 29,900. That's our net profit.
to negative 13
Negative 13.
because you might
No, you should do it positive. It's okay. 13,000 what?
900.
13,900. So what's the total for the 16,000, right?
Yes.
So we have 16,000. So we have 13,900. That's our net profit. Is it clear?
Net profit of the income statement.
Net profit, that's the statement of profit or loss. This is the profit for the year. We call it net profit or profit for the year.
Yeah,
Is it clear?
yes, and now we're going to do the
Statement of profit or statement of financial position.
we can state the financial position with all of the trade balance. So I need to have the loss.